One. Hello, everyone. This is Noah and John, and we are from UrbanDigs, and it is Friday. So we are going to give you a Manhattan weekly market report. John, this is what we do. Let's not waste any time. We got some cool stuff, unique stuff to look at. This is historical day. Let's go back and do some crazy comparisons to that crazy crisis that happened 11 years ago. But here's where we start out with inventory. We came in at 8134. It looks like we're ticking up, but we're not ticking up nearly as much, John. Throw the chart up.
Yep, there's the chart. 8134. It's about 1% up from last week. I mean, it's starting to level off here.
Yeah, and level off is the key. That's what we want to see. The last thing we need is inventory popping up another couple of thousand. Great. Let's move on to pending sales. Pending sales came in at 1431 for the week. Sluggish. I mean, we're going up, but I mean, it's
well, you can see it right here. It looks to me like the bottom is forming. We're up a little bit from last week, so we're up off the lows. I think is the key to take away here.
And I keep forgetting that everything has phase 1, phase 2, and phase 3, and that pending sales is in that phase 2, and it's in the bottoming phase, and it's just starting to get into that phase. So that's actually not a bad sign. But I would love to see that thing just pop higher. I just want to see it. All right. Yeah. So here's what I just want. Before we go to 1 weeks, right? We always do 1 weeks, Johnny. Mm-hmm. I want to make a mental note that last month we booked around 2,400 listings came on the market and 500 listings went to contract. 2,400 and 500. So that when we move to 1 week, we have a frame of reference of whether or not the pace is increasing or decreasing, right? Because we want to stay ahead of the curve, right? We want to keep the clients ahead of the curve. All right. So 1 week active. Where do we come in? Ding, 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 ding. 524. Johnny, where is that?
Well, check it out. I mean, you can look at this chart here, and let me just save you the trouble of analyzing. And I'll just tell you right now that it's the lowest weekly number we've had since the reopen. If you take out the holiday week, that's the lowest we've had on a weekly basis since the reopen. So, I don't want to get ahead of myself, but I feel like the top might be in on weekly new listings here.
That's a good point. This is the lowest, excluding July 4th. That's right. So we're on a monthly pace of just over, 2,100, and we're at 2,400 last month. So that's a good sign. We want to see that come down a little bit. We want to see that normalize.
Yeah, and I think the only if you're looking at here, if you're scoring at home, we've had 7 weeks of over 500 listings. So that's concerning. But as that number comes down, I think hopefully the top is in.
Okay, good stuff. All right, let's move on to 1 week contract signed. 1 week contract signed. We love me some contract signed. 179. That's a tick up. So that's not so bad. I can't get upset here.
Sure. Well, it's actually a tick down, tiny tick down about 2% from last week. But look, we're up off the lows. It's okay.
I am off my game. I thought.
I
just quit.
There's only so much I can say, man.
All right, so we're down from last week.
We're down from last week, but it's okay. These are basically holiday week numbers. So if you looked at how we were doing in terms of contract signed on a normal year, these would be numbers you would see sort of in a holiday week, like July 4th, Labor Day. These are the kind of numbers you see. So the market's moving. It's just moving at a abbreviated level.
Right, and we're at mid-August. It's not the hottest. Well, it is hottest month, but it's not the hottest in terms of activity, in terms of our market. It's actually quite the opposite. It's the lowest. But the only thing that's different this year is that we didn't have an active season, and this is kind of our first glimpse of an active season because we reopened and we could do business. So, all right, I still want to see that thing over 200, John. I guess that's why I'm disappointed. So there it is. It's out there. When I see that do 200, I'm going to start dancing a jig on this show, all right? And I'll have the video on.
All right, I'm going to timestamp that and mark it in my head.
Let's move on to the good stuff, John. You got some historical perspective, right? Show me some historical perspective.
So one of the things that, that's a great point. So one of the things we want to do is, we've had a lot of questions. How does this market relate to the one of the great financial crisis? So
2008, 2009.
2008, 2009. And I think one of the cleanest way to look at that is supply versus demand. And let's just take a look at that. So I'm putting some charts up here. I'm going to start with supply. Let's go all the way back to March 2007 and just look at monthly supply. Mm-hmm. And you can see there, we're approaching those 2009 highs. We're about 900 listings or so away. And, based on what I just saw, I'm not sure if we're going to get there. What do you think, Noah?
Well, I'll tell you what, I mean, I think after Labor Day, we typically have that bounce in the regular calendar year. I'm wondering if sellers are holding off listing until after Labor Day for whatever reason, because they're just, August is not the month. Yeah. And they're ignoring the whole COVID reopen thing. So I'm wondering if we have two shifts, two phases of supply about to come, and we're in the middle of that lull right now, and that might bump up again after Labor Day. That's my concern.
You're quite right. That could possibly happen.
Yeah, so in that case, we could go up, but that is very interesting. We're about 900 some odd listings away from breaking that 2009 record supply. So that is really interesting. What else you got?
Well, it's like a pending sales going all the way back again to March 2007. And, you can see we drew a line across the screen there. So you can kind of see there was the lows are somewhat similar. But, what's interesting is look at the 2009 hit. And the similarity is kind of like, look, we fell from 2009 all the way down to where that line is. That's a big fall.
Yeah. So yeah, I see what you're saying. So the 2009 cycle, we fell from a much higher point, because I mean, this chart that I'm looking at right now, it looks like we were coming back. I mean, this actually shows that we were coming back from it pre-COVID, and that was at a level that was down after 4 years, which everyone knows. We had an upcycle peak in 2015. We had a progressive decline. This shows it great. It actually shows that bottoming and slight comeback, and then COVID hit. Whereas 2009 was a fall from a peak.
Yeah.
What do you make of that, Johnny?
Well, I think you're exactly right. And I think that's really the difference between the two markets is that the pending sales number was unsustainable in 2007. We were doing 4,000, 4,500 a month. And the market was just gangbusters, ready for a fall essentially. And then the financial crisis happened and gave us that fall. And it was a big fall we fell from up high all the way down low.
Here's a perspective. I'm sorry, go ahead.
No, I'm saying here, you're right. We were coming back. And so we have fallen from a much lower number to begin with.
A number that was already down. So here's another perspective for all those buyers, John, that are out there saying, I want 20, 30%. Why aren't they hitting my bids? Think about it this way. In the great financial crisis, we just fell 25, 30% in a cliff dive straight down.
Yep.
Whereas this cycle, we were down 10, 12, 10, 15% from 2015 to 2019 already. And we're telling everyone we're down an additional 10, 12% from that point. And I think buyers have it in their head that they need to fall an additional 30% from where we were pre-COVID, when it doesn't really work that way, and sellers are not playing ball that way.
Noah, you're exactly right. And I'm putting a chart up here, which is basically our market pulse chart. And it's a simple ratio of demand to supply. So if you take the demand, you divide it by supply, that's your market pulse. And if you look here, we are really close to our 2009 levels. So if you've got a buyer that's thinking, man, I wish I would have bought in 2009. I mean, really now's your chance in terms of market sentiment. That's pretty much where we are.
And this is a barometer of the market. This is a leverage of the market. As it falls, market's weakening. As it goes up, the market's strengthening. That is a very good point. So the dynamic looks like it is as close to that period of time. We don't want to say it, but that period of time back in 2018, 2009. And I would say the only difference is that the willingness of sellers to hit those bids. I don't think every seller is hitting those bids, and that's what buyers are figuring out, and they're meeting in the middle. This has been great. Thank you so much. John Walkup from UrbanDigs. Thank you so much. My name is Noah Rosenblatt. I'm also from UrbanDigs. This has been your weekly Manhattan Market Update, and we'll catch you next time.